Hello everyone. Let us do practical questions of corporate valuation. Please read the question number 1. See, in SFM always what you have to remember is you have to start reading what is being asked in the question. So you have to go to the end of the question and just read what is being asked in the question and then go through the entire question. So that helps you save your time in capturing information and all. Okay. So please read question number 1. Yeah. So what is being asked in the question? See, there's a company that is considering acquisition of another company, and the target company's number of shares is 1.5 crores. Its market price is 400, and cost of capital of the acquirer is 12%, and expected cash accruals of a target company's next 3 years is given. So we need to find the range of valuation. So how many types of valuation are there here? One is based on market value. The other is DCF method. Right. Correct. So let us solve it. Valuation method, value, per share value, right? This total value should be in crores. Right? So what are the methods? Market price, DCF. I'm just using shortcuts, but you don't do it, right? What is total value? 400 into 1.5. What is per share value? This by 1.5, right? So yeah, DCF method we'll find out. So value based on DCF method, we have to create a working note. Okay, working, right? So here cash flow, here cash flow, then PV factor, 12%, and then DCF. Okay, yes. One. What are the cash flows? 250, 300, 400. What's the PV factor? Okay, 0.893, 797, 712. Now discounted cash flow, that is PV factor into cash flow, right? So what is the value? Summation of all these amounts. Okay. This is as per DCF method. What is per share value? This by 1.5 crores. Okay. So this is a solution to the problem. Very simple. Now let's go to question number 2. Please read the question. First, just check what is being asked in the question. Okay, he's asking to calculate the value of business at a capitalization rate of 14%, and also market price per share. With the Eagle's share capital being so and so, you just have to find out MPS. Now just read the question once. So what's being asked in the question? See, there's a company called Eagle. It has a profit of 77 lakhs after tax. Okay. And some analysis it revealed that there was an extraordinary item of both income and loss. Okay. And the existing operations, except for those extraordinary items, are expected to continue in future. And in addition, there's a launch of new product, and its sales and cost figures are given. So you have to find out the value of business at the capitalization rate of 14%. So how do you approach the problem? First, your PAT is given, so you'll convert it into PBT, right? Then you'll adjust for this extraordinary, gains and losses. Okay. Then what do we do? Then we'll take into account the profit of the profit corresponding to new product, and then again we will find out PBT, and then we'll adjust for tax and find out PAT, and then at the capitalization of 14%, we'll find the value of business, right? And once that is done, since PAT, you'll subtract preference share dividend from it, and then find out earnings available to equity shareholders. And when you do it, when you divide it by number of equity shares, you get earnings per share, and you will multiply by price equity ratio, and you will get the market price per share. So this is what the approach we are following, right? So now let us solve the problem. Plus amount. Okay. First, what is given? PAT. Since tax rate is 30%, your PBT will be PAT by 0.7, right? This is equals to this by minus 0.3, right? So you got your PBT. Now you will adjust for extraordinary loss and extraordinary income. Extraordinary loss you'll add, extraordinary income you'll subtract. Extraordinary loss 10 lakhs minus 8 lakhs, 10 minus 8, right? Now profitability of new product. Sales, material cost, labor cost, fixed cost. Sales, labor cost, fixed cost. $70, $20, $12, $10. 70, right? So adjusted T is equals to summation of all these. Now, what is the capitalization rate? Sorry. So adjusted is equals to this into 1 minus 0.3, right? So 98. This is equals to 14%. So what is value of this? Is equals to adjusted that by capitalization factor. So value of business is 700 crores. Got it? Now let us find out market price. Here, take adjusted fact into consideration. Okay. You can take adjusted fact into consideration. Yes. Let's differentiate dividend. This is equals to 13% of 100 of 1 lakh. Okay. Since it doesn't, yeah. Max 13. Okay. So equity share holders, that is equals to this should be minus, right? Yes. So yes. Okay. The number of equity shares, 50 lakh of 10 each. So EPS is equals to earnings by numbers. So 1.7. What is the price earning ratio given? 10. So what is market price? EPS into EPS into price earnings ratio. Okay. Now let's do problem number 3. Just check what's being asked in the question. Determine the incremental value due to adoption of the strategy. Okay. Now let us see what is the question right from the start. See, there's a company that is considering a new sales strategy that will be valid for next 4 years. And there's an income statement given for the year that has just ended. So what all details are given? You have sales, you have gross margin at 20% of sales, admin expense at 10% of sales. So you get PBT minus tax rate at 30%, you get PAT. Then you have balance sheet information. That is, you have fixed assets and current assets. So additionally, what is being given? See, if it adopts a new sales strategy, sales will grow at 20% per year for 3 years. From 4th year onward, it will stabilize. So from 4th year onward, the sales value will be equal to that, which it was during the 3rd year. Then the gross margin ratio, asset turnover ratio, the capital structure, and income tax rate will remain unchanged. So the gross margin ratio will always be 20% on sales. Asset turnover ratio, that is, will be same. So fixed assets as a percentage of sales and current assets as a percentage of sale, they remain same, right? Income tax remains same. Now depreciation would be at 10% of net fixed assets at the beginning of the year. Okay, and you have company's target rate of return as 15%. That is, the discount rate is 15%. Now what is being asked? Determine the incremental value due to adoption of the strategy. Okay. So how do we approach the problem? First, we need to find out what is the current value of the business before adoption of strategy. That is what? PAT by discount rate. That is 1400 by 15%. Okay. Now we have to find out what is the value of business after adoption of the strategy. How do we find out? We will find out all the future cash flows, and then we'll discount them at 15%. And then we get discounted cash flows. Summation of all those discounted cash flows gives us value of business after strategy adoption. How do we find out the future cash flows? We will find out future cash flows by, first we'll find out sales, then gross margin at 20% on sale, then admin expense at 10% on sale. So you get PBT at 10% on sale. Then you'll reduce tax, so you get PAT. Then you will add back non-cash item like depreciation, and you will subtract that with capital expenditure, and also you'll adjust for working capital changes. So that gives you future cash flows. Okay. So in order to know capex, first you should find out closing balances of fixed assets, and in order to know change in working capital, you have to find out closing balances of current assets. So first that you have to find, and also it is given that the asset turnover ratio remains the same. That means percentage of fixed assets on sales and percentage of current assets of sales remain the same. So this is how we are going to approach the problem. So now let us go to Excel to solve it on it. Computation of value of business after strategy adoption. Okay. Particulars. Here 0, 1, 2, 3, 4. Right now, sales. What is the value? 20,000. What is being told? It will grow at 20% per annum first 3 years. Then on it will stabilize. So this is into 1.2. So 20, 24. Thereafter it will stabilize. Okay. Next, gross margin. This is at 20% on sales. That is equals to this into 0.2. Okay. So yes. Next, admin expense. This is equals to 0.1 into sales. This, since there is an expenditure, it is minus. Okay. So you get PBT. This is nothing but gross margin minus admin expense. Okay. So PAT. What is PAT? PBT into 1 minus tax rate. Is the tax rate 30% here? Yes. So you got PAT. Now you have to add depreciation. Okay. What is depreciation? Depreciation is 10% on net fixed assets at the beginning of the year. Okay. So for this, we'll actually create a working note. We'll actually create a working note below. Okay. Closing balances. Assets. Right. Asset. Fixed. Current. What's given in the question? 8,000 and 4,000. 8,000, 4,000. And we told that the ratios remain the same. Okay. So that means, let us just check what is the ratio. That's it. Percentage of sales. Okay. 8,000, 4,000 is equals to this by this, is equals to this by this. What is the percentage? 40% and 20%. Now what you will do is equals to this into this. Is equals to this into this. So what's the depreciation? Is equals to this into 0.1, right? You got depreciation. Now capital expenditure. Capital expenditure, it is nothing but, see, fixed assets have increased from 8,000 to 9,600. So that means it is 1,600 of increment. But that also includes 800 as depreciation. That means this 9,600 value is after considering depreciation. So So what is the capital expenditure? 9,600 plus 800 minus 8,000. So closing value plus depreciation minus opening value, right? So this is the capital expenditure. Let me just put minus because it is a cash outflow. Okay. So yes. Next, changes in WC, working capital. So what is the change in working capital? minus 400. Since it's already minus, because it's a cash outflow, right? So I just did year 0 minus year 1, right? So this is future cash flow is equals to sum PBT, no, PAT, yes. So PV factor at 15%. So what is the value? Is equals to 1 by 1.15 is equals to this year 1 by 1.15. The same goes with third year also. Fourth year, there's you have to adjust something. See what happens from third year onwards. I mean from fourth year onwards. This will be your future cash flow. Fourth year, fifth year, sixth year, seventh year, eighth year, everything. Okay, this will be your future cash flow. So all those values you have to bring it to present value at the end of third year. So what do? Is equals to 1 by, that means you take the perpetuity formula, 1 by 0.15. So at the end of third year, this is the value of rupees 1 when you discount all those future cash flows at the end of third year. Now since this value is at the end of third year and it has to be brought to year 0, what do? We multiply this thing by PV factor at year 3, right? So discounted cash flow is equals to future cash flow into PV factor. Okay. And what is the value of business after strategy adoption is equals to sum of all these things. Okay. So what is the value before adoption? As I earlier said, it is 1400 by 0.15. That is the pattern. So incremental value. What's the incremental value? There's no incremental value. It was more earlier. So therefore the strategy is not feasible. Okay, this is the conclusion that you make, right? Just highlight this. That's all. Now let's read question number 4. So let's check what is being asked in the question. we need to arrive at the value of shares of both H Limited and B Limited under net asset value method, earnings capitalization method, and we need to find the exchange ratio of shares of H to be issued to B Limited shareholders on a fair value basis. Okay. So let's go to the question. What is given? There's a company H Limited that agrees to buy B Limited, and balance sheet of both the companies as on 31st March 2012 are given. Let's go to the balance sheet. Equity shares, business surplus are given, and on asset side, fixed assets and current assets and deferred tax assets are given. Okay. Now, H Limited proposes to buy B Limited, and the following information is given with regard to scheme of buying. Okay. Let's go to each and everything one by one. Weighted average post-tax maintainable profits of both the companies for last years are 300 crores and 10 crores respectively. Both the companies envisage a capitalization rate of 8%. H Limited has a contingent liability of 300 crores, and H Limited to issue shares of 100 each to shareholders of B Limited in terms of exchange ratio as arrived on a fair value basis. For this, we need to consider weights of 1 and 3 for net asset basis and earnings capitalization method. Okay. So how do we approach the problem? First, we'll find out value of shares as per both the methods, net asset value and earnings capitalization method. Net asset value, how do we find out? See, we are being given paid up share capital and reserves and surplus, right? So we'll add those two and we'll subtract contingent liability only in case of H Limited. So we get the value and we divide it by number of shares. So we get per share value. And earnings capitalization method, we divide 300 crores by capitalization rate, that is 8% in case of H Limited, and 10 crores by 8% in case of B Limited, right? So we get the value and we divide both of them by their respective number of shares, so that we get per share value. Okay, so now we need to find out the fair value. How do we find out the fair value? Based on NAV value and earnings capitalization method value, we'll just add weights 1 and 3 and we'll find out the fair value. And how do we find out the exchange ratio? Exchange ratio is equals to fair value of B Limited by fair value of H Limited. So this is the method we are going to follow to solve the problem. Now let's go to Excel. Particulars. NAV method. Amount. Right? NAV method. What all things are need to be considered? Equity, reserves and surplus, contingent liability. Sorry, H. This is B. What is equity? Okay, in crores, right? 350, 950. H 6.5, 25. So, yeah. NAV. These. Okay, everything is in crores. Okay, this we have to mention it here. What is the shares outstanding? Shares outstanding is 350 by 100 and 6.5 by 10. By 10. Okay. So what is per share value? NAV by number of shares. Yeah, so this is NAV method. As per earnings capitalization method. Okay. What is it? Weighted average post-tax maintainable profit. Weighted average post-tax maintainable profit. $310. Rate 8%, right? So what is the value? 300 by 8% and 10% by 8%. Per share value, that is equals to this by this. Right? Now, on fair value basis. What are the weights? NAV value into 1 plus per share value into 3, sorry. By 4. $875. Right? What is the exchange ratio? He said exchange ratio should be based on fair value method. This is equal to fair value of B divided by fair value of H. So this is the exchange ratio. So there is a solution. Now let's do problem number 5. So what is asked in the question? Calculate the total value of business of XY Limited, the number of shares to be issued by AB Limited, and the basis of allocation of shares among shareholders of XY Limited. Okay, so what is the scenario here? See, AB Limited is planning to acquire and absorb the running business of XY Limited. The valuation is to be based on recommendation of merchant bankers, and the consideration is to be discharged in the form of equity shares to be issued by AB Limited. Then it is given that the paid up capital of AB Limited consists of 80 lakh shares of 10 each. The highest and lowest market quotation were 570 and 430. For the purpose of exchange, the price per share is to be reckoned as average of highest and lowest. Okay, that means 570 and 430. That means 570 plus 430 by 2, that comes to around 500. Okay. Balance sheet of XY is Limited is given. You have share capital, and you have two kinds of equity shares. One is fully paid, one is partly paid. Okay. Then you have loans. Then you have fixed assets and net current assets. Also, it is given that an independent firm of merchant bankers engaged for negotiation have produced the following estimates of cash flows from business of XY. Okay, these are the cash flow that they are expecting. And it is given that it is after tax earnings for equity. Okay, after tax earnings for equity. Okay. Then you have terminal value estimate, right? Okay. Then it is recommend. Yeah, this is important. It is a recommendation of merchant banker that business of XY Limited may be valued on the basis of average of aggregate of discounted cash flows at 8% and net asset value. So average of aggregate of discounted cash flow and net asset value. So value as per DCF method and value as per NAV method, have average of those two values should be the value of the business, right? Okay. So how do we approach the problem? First, we will find out the value as per DCF method, then value as per NAV method, then we'll find the average of those two to find out the total value of the business. Then to find the number of shares to be issued by AB Limited, we'll divide the value of the business by 500. That being the average of 470 and 530, which is actually considered for the purpose of exchange. Then what is being asked? The basis of allocation of shares among shareholders of XY Limited. So these shares should be split among fully paid equity shareholders and partly paid equity shareholders in the ratio of 200:50, right? Okay, so we'll solve this problem on Excel now. Here, cash flow, PV factor, at 8%, then DCF. How many years? Okay, year ended. Seven to 11, right? Two 2010. I mean, sorry, 11. 2011. Okay. So what are the cash flows? 105, 120, 125, 120, 105, 120, 125, 120. And last year it is 100 and 200 together. Terminal value estimate is equals to 100 plus 200. So it is 300. So yeah, present value factors at 8%. 0.93, 0.86, 0.93, 0.86, 79, 74, 68, 74, fix it. So DCF value, if that is equal to cash flow into PV factor, right? Oh, sorry. What is sum of all this? So this is the value as per DCF method. So what is the value as per NAV method? Value as per DCF. Value as per NAV method. Value as per NAV method, right? So it is 350 minus 100. So what is the value of business? Is equals to average is equals to so this is the value of business. Market price per share of limited is equals to 570 plus, or you can just say average of, okay, let me just find out. Okay, 570 plus 30 by 2, right? That comes to around 500. So number of shares to be issued. This one I just write in lakhs. Number of shares to be issued. Is equals to, this is again in lakhs. is the last basis of allocation. So issue to shareholders partly paid shareholders. It is 250. Control Z. Just 50. Is equals to 200 by 250 into this into 1 lakh equals to this into 1 lakh, or you can also write as 50 by 250 into this into okay. So there is a solution. Now let's do problem number 6. What is being asked in the question? What is the correct value of Hansel Limited? What is the question? The valuation of Hansel Limited has been done by an investment analyst and based on expected free cash flow of 54 lakhs for the following year and an expected growth rate of 9%, the analyst has estimated the value to be 1800 lakhs. However, he committed a mistake of using the book values of debt and equity instead of market values, right? The book value weights employed by analyst are not known, but you know that Hansel Limited has a cost of equity of 20% and post-tax cost of debt of 10%. It's also given that the value of equity is thrice its book value, whereas market value of its debt is 9/10, that is 90% of its book value. So we need to find out the correct value of Hansel Limited, right? So how do we approach the problem? First, what all details are given? See, expected free cash flows are given. Then you have growth rate. Then you have value of Hansel Limited based on book value weights. So we'll draw an equation that is 1800 lakhs is equals to 54 lakh by weighted average cost of capital minus 9%. This is actually value is equals to expected free cash flow by weighted average cost of capital minus growth rate. Using that particular formula, we will derive weighted average cost of capital. So what is weighted average cost of capital? Weight of equity into cost of equity plus weight of debt into cost of debt, right? So let us assume that weight of equity is A. So weight of debt will be 1 minus A. So A into 20% plus 1 minus A into 10% is equals to WACC derived above, right? So we can find out the book value weights of both equity and debt using this particular equation. Then what do we do? Since we know book value weights, we'll multiply book value weight of equity in 3 times and we'll take weight of debt, we'll multiply it by 90% to get market value weights, and using these weights we'll find out weighted average cost of capital based on market value weights, and using this weighted average cost of capital once again we'll find out the value of Hansel Limited. So this is how we are going to do the problem. Now let us put it on paper, I mean Excel. Net $54 lakhs by WACC minus 9% is equals to 1800 lakhs, right? So WACC minus 9% is equals to is equals to 54 lakhs by 1800 lakhs, right? So WACC is equals to 54 by 1800. What is 54 by 1800? 18 threes, 18 by 100, 3% plus 9%. 3% plus 9%. So WACC is equals to 12%, right? So what is WACC? Let us assume the book value, weight of equity and debt to be A and 1 minus A respectively. Okay, so WACC is equals to 12%. So 20% into A plus 10% into 1 minus A is equals to 12%, right? So 0.2A plus 0.1 minus 0.1A, that is equal to 0.12. Okay, so 0.1A is equals to 0.12 minus 0.1, that is 0.02. So A is equals to 0.02 by 0.1, that is A is equals to 0.2. So 1 minus A is equals to 0.8. So book value weights of equity debt weights book market equity book is 0.2, 0.8, right? What is market? 3 times of this. What is this? 90% of this. So these two weights we are supposed to use. Now, so WACC is equals to 20% into 0.6 by 1.32 plus 10% into 0.72 by 1.32. So WACC is equals to now let me use calculator 1 minute. Okay, so it is 14.55. %, right? So now this thing we'll put it in the first formula. So value of business is equals to 54 lakhs by 14.55% minus 9%. Okay, so business is equals to, let us just choose a formula, is equals to 54 divided by 0.14 divided by this minus 0.09. So it is 973 lakhs. So this is the solution. Now let's do problem number 7. So what is being asked in the question? He is telling us to find out the value of the firm. Okay. Now let's read the problem. See, the company is expected to grow at a higher rate for 4 years, after which growth rate will stabilize at a lower level. Okay. This is the base year information. You have revenue, EBIT, capex, depreciation. Information for high growth and stable growth period are as follows. You have growth and revenue, EBIT, capital expenditure, depreciation, risk-free rate, equity beta, market risk premium, pre-tax cost of debt, debt equity ratio. For both, all these details are there for both high growth and stable growth periods. Okay, and for all time, working capital is 25% of revenue and corporate tax rate is 30%. He's asking us to find out the value of the firm. So, don't you think this problem is similar to problem number 3? How do you approach the problem? It is very simple. Just like problem number 3, first you take EBIT for all the years, both for high growth period and low growth, stable growth period. Then you will subtract tax. So, sorry, you will subtract interest. Just hold on. Do we have anything here? Interest, pre-tax cost of debt. There is no interest given, right? So, yeah, since there is no interest given, then we'll subtract tax from it. So you get earnings before interest, but after tax. Then you'll add back depreciation, subtract capital expenditure, for all the periods, high growth period, stable growth period, you have to just be careful, because for both the periods, these the growth rates are different. Then since the working capital is 25% of revenue for both the periods, you can easily find out the change in working capital, the net addition or subtraction. Then you get future cash flows. Then using the discount rate, you find out discounted cash flow, and summation of all those cash flows gives us the value of the firm. But here what we need to keep in mind is the weighted average cost of capital for both high growth and stable growth might be different. So first we need to find out the weighted average cost of capital of equity and debt. Sorry, not weighted average cost of capital, the cost of capital of equity and debt. Then find out weighted average cost of capital of equity of high growth period and stable growth period. Then in order to find out the terminal value, you have to use WACC of stable growth period. Then for high growth period, you have to use WACC of high growth period. Then after discounting it to year 4, then we need to use we need to discount it at WACC pertaining to high growth period, right? So let's solve 7th problem. Computation of value of the firm, right? Particulars here. 0, 1, 2, 3, 4, 5. Right? March. Center. Okay. Also this one is in cross. What is given? Revenue EBIT. Okay, revenue EBIT. Then is interest expense given? No, you cannot find out interest expense because debt amount is not given, although debt interest rate is given. So we'll find out earnings before interest but after tax. That means you'll remove tax from EBIT. Then you get EBIT. Then what do you add? Depreciation. Okay. Then you subtract capital expenditure. Then you adjust for change in working capital. Okay. So now let us take revenue for base year. That is what, let us just put in all the base year figures. Okay. 2,300, 2,300. So this comes to around 300 into 1 minus tax rate. Okay. That is 210. What is depreciation? 200. Capex is 280. 200. Capex is minus 280. Okay. Now, high growth, revenue and EBIT grow at 20%. For stable growth, it is 10%. So this into 1.2, right? So this one also into 1.2. This will continue till 4th year. Okay. 5th year also, 5th year it will be 1.1, right? Here also it will continue till 4th year. 5th year, instead of 1.2, it will be 1.1. Okay. Right. Then here it is future cash flow. Then it is PV factor at WACC. Then it is DCF. Then it is value of the firm. So even if you check third question, this is the same format that we used earlier. Okay, so what is EBIT? It is nothing but EBIT into 1 minus tax rate. Okay, now depreciation. Depreciation also, both depreciation and capital expenditure grow at 20% in high growth period. Then later they'll get offset. So this into 1.2, that is, yeah, and also this into 1.2. Here it is offset. Okay. Next, change in working capital. What is that working capital? It is 25% of revenue for all times. That is 0.25. So here we require change, right? So this revenue at year 0 minus revenue at year 1. No, there is something wrong. We just need to copy this. Okay. Yes. Next, future cash flow. This is sum of all this, right? Yes. Now we do not know the discount WACC, right? We do not know weighted average cost of capital. So here in a working note, we'll find out WACC. So during high growth period, stable growth period. Right? Okay. So here it is cost of equity. What is cost of equity formula? RF plus beta into RM minus RF, right? Yes, you just merge it. Okay. So here, what all details are given? You have risk-free rate, you have equity beta, you have market risk premium. What is market risk premium? RM minus RF. So what you have to do to find out cost of equity? We have to we have to add risk-free rate to equity beta into market risk premium. Okay. So it is 10% plus 1.15 into 6%. This is 10% plus 1.15 into 6%. 6%. Here it is 9% plus 1 into 5%. 9% plus 1 into 5%. So here you will get 6.9, 10, 16.9%. Here you will get 14%. Okay. Then cost of debt. That is pre-tax cost of debt into 1 minus tax rate. 13% into 1 minus 0.3, 12.86% into 1 minus 0.3, 12.86% into 1 minus 0.3. That is equals to did you get it? No, sorry. that comes to 9.1% here. It comes to 9% here. So okay, so this is cost of debt. Now let's find out weighted average cost of capital. So for that we require weights, or yeah, rather let me say debt equity ratio. What's the debt equity ratio? 1:1, 2:3. 1:1. 2:3. So WACC is equals to cost of equity into its weight, that is 1, plus cost of debt into its corresponding weight, that is 1 here, divided by sum of weights, that is 2. So it is 13% here. Next, similarly here, cost of equity into its weight, that is 3, plus cost of debt into its weight divided by sum of weights, that is 12%. Okay, so this is the working note. Now, so we have two discount rates. One is 13%, one is 12%. So for first 4 years, we'll use 13% because that is for high growth, and for future years, we'll use 12%. So this is equals to 1/1 plus this. Is equals to this divided by 1 plus this. This divided by 1 plus this equals to this divided by this. So these values would be this much. Okay, so what happens for 5th year? See, this cash flow will continue till perpetuity at a growth rate of 10%. So what you have to do, you have to use the perpetuity formula, right? So if we have 1 rupee as annual, annual cash payment for year 1, and then if growth rate is 10%, then what would be the present value? The present value would be 1 by is equals to 1 by your weighted average cost of capital minus growth rate, that is 10%. Yeah, see, growth in revenue in EBIT is 10%. So that is a growth rate. So 10%. But this value is as on year 4, year 4 ending. So we have to discount it further to bring the value to year 0. right? So for that we have to multiply this by PV factor at year 4. Okay, so we get 31. Now let us find out the discounted cash flow, that is future cash flow into PV factor, right? So the value of firm is sum of all these values. So it is 11,722 crores. So this is the value of the firm. Okay, so this is the solution. Now let's go to 8th question. Okay. See, 8th question is same as 7th question. So we'll just skip. The only thing, the only difference is that you need to find out EBIT using revenue, cost of goods sold and operating expenses. So revenue minus cost of goods sold minus operating expenses is your EBIT. Okay. Apart from that, everything is the same. So we'll go to 9th problem. Okay. So what's being asked? See, we need to find out the economic value added. Capital structure is given. That is, equity capital is 160 lakhs, reserves surplus 140 lakhs, 10% debenture 400 lakhs. So equity is 300, debenture is 400. Okay. And cost of equity is 14%. Cost of debt is 10% into 1 minus tax rate, that is 30%. Financial leverage is 1.5 times. What is financial leverage? It is EBIT by EBT. So income tax rate comes to 30% as given in the question. Okay, so we'll solve this problem. So first condition is financial leverage is equals to 1.5. That means your earnings before interest and taxes by earnings before tax is equals to 1.5. Okay, let EBIT be X. So X divided by what is EBT? EBIT minus interest expense. So X minus interest equals to 1.5, right? So let us solve for X now. So what is interest amount? It is 10% of 400 lakhs. So X divided by X minus 10% into 400 lakhs is equals to 1.5. So what is 10% of 400 lakhs? 40 lakhs. So X divided by X minus 40 lakhs is equals to 1.5. Okay. So now solving this, let us take X minus 40 to the right hand side. So X is equals to 1.5 into X minus 40 lakhs. Okay, that gives us X is equals to 1.5 X minus 1.5 into 40, that is 60 lakh, right? So bringing 1.5x to the left hand side, you get 1.5x minus x bringing x to the right hand side and 60 lakh to the left hand side, right, is equals to 60 lakhs, right? So X is equals to 120 lakhs. So EBIT is equals to 120 lakhs. So what is you're supposed to find out economic value added. Okay, EVA is equals to NOPAT minus WACC into total capital, right? So what is NOPAT? NOPAT is nothing but EBIT into 1 minus tax rate, right? So NOPAT is equals to EBIT into 1 minus tax rate, that is equals to 120 lakhs into 0.7, that is equals to 84 lakhs. That is equals to 84 lakhs. So what is WACC? This one we'll calculate now. We'll do a working note. Okay. How much is the equity? 160 lakhs plus 140 lakh. 160 lakhs. Plus 140 lakh, that is equals to 300 lakhs. Debt, it is 400 lakhs. So debt equity ratio, that would be equals to 4/3, right? So now WACC is equals to, what is cost of equity? 14%. 14% into 3/7 plus, what is cost of debt? Cost of debt is 10%. You have to do post-tax cost of debt. That is 10% into 1 minus tax rate. 10% into 1 minus 0.3, right? That comes to around 7%. 10% into 7, 7%. Into what is its weight? 4/7, right? So 14 into 3/7 plus 10 into, so WACC is equals to, here it becomes 7%. So WACC is equals to 6% plus 4%, that is equals to 10%. Okay, here we'll just put percent. So WACC is 10%. What is total capital? Total capital is nothing but 700 lakhs. Okay. $700 lakhs. So EVA is equals to, what is NOPAT here? NOPAT is 84 lakh. 84 lakhs minus what is WACC? 10%. 10% into what is total capital? 700 lakh. So EVA is equals to 84 lakhs minus 70 lakhs. So EVA is equals to 14 lakhs. So that is the solution. Now let's do problem number 10. So what is being asked in the question? Estimate WACC and estimate EVA. Okay. So what is being given in the question? See, you have its current FI's income statement, which has reported its net income after tax as 25 lakh. Applicable income tax rate is 30%. Following is the capital structure. Debt having a coupon rate of 11%, it is 40 lakh. Equity share capital plus reserves and surplus is 125 lakh. So invested capital is 165 lakh, right? So along with that, you have estimate of cost of equity. That is, you have equity beta, risk-free rate, average market risk premium. Okay. So what is cost of equity? RF plus equity beta into average market risk premium, right? With that, we'll find cost of equity. We have cost of debt, that is coupon rate into 1 minus tax rate. We have weights, that is 40 lakh and 125 lakh, that is 40 is to 125. And we'll find out WACC. Okay. Then what is EVA? EVA is equals to NOPAT minus WACC into capital employed. So you have capital employed, you have WACC. So you require NOPAT. So what is NOPAT? NOPAT is nothing but EBIT into 1 minus tax rate. So how do you find out EBIT? You have net income after tax. So you will add back tax so that you get EBT. So you add back interest. So you get EBIT, right? So this is how you are going to solve the problem. Okay. So first, cost of equity. What is the cost of equity? Cost of equity is equals to RF plus equity beta into RM minus RF, right? So here KE, that is cost of equity, is equals to what is RF? RF is 8.5% plus 1.36 into 9%. 8.5% plus 1.36 into 9%. 1.36 into 9%. It's not 2.36. Sorry, it is 1.36 into 9%. So that gives KE is equals to 1 minute. So what is the answer? 8.5 plus 1.36 into 9%, right? So it is 20.74%. So KE is equals to 20.74%, right? So what is KD? Cost of debt. Cost of debt is equals to coupon rate into 1 minus tax rate. Coupon rate, that is 11% into 1 minus 0.3. Okay. So that is, so cost of debt is equals to, so KD is equals to 11% into 1 minus 0.3, that is 7.7%, right? So what are the weights? So WACC, how much is the debt? That is equals to Debt is equals to 40 lakh, equity is equals to 125 lakh, right? So debt is equals to 40 lakhs, equity is equals to 125 lakhs. So WACC is equals to 20.74, that is cost of equity into its respective weight, that is 125 into 125, okay, plus this is 20.74%, right? 125 plus what is debt, cost of debt, that is 7.7% into 40, total divided by what is the sum of both the weights, it is 165. It is 165. Okay, so WACC is equals to this much, right? So now let us find out the value. So it is 17.58%. So WACC is 17.58%, right? Now we have to find out EVA, computation of EVA. This is nothing but NOPAT. Okay, first we'll find out NOPAT. For that, we'll take net income or EAT. What is its value? It is 25 lakhs, right? 25. We'll just put particular amount. This amount. Okay. Right. Yes. Now, so what is EBT? EAT by 1 minus tax rate. EAT by 1 minus tax rate. Right. So now what is interest? Interest is nothing but coupon rate into debt. That is 0.11 into 40. Oh, I'm forward. Okay, so we get EBIT. EBIT is nothing but interest plus EBT, right? So now NOPAT is EBIT net of tax. This is equals to this into 1 minus tax rate. Okay, so this is NOPAT, right? NOPAT. Now WACC is equals to 17.58%. What is total capital? Total capital is nothing but 165 lakhs, right? So what is EVA? EVA is equals to NOPAT minus WACC into total capital. Sure. So we get a negative EVA, is it? Just check. Is equals to this into this 29. Yes, correct. So this is the EVA. So this is the solution to the problem. Now let's do problem number 11. What is being asked in the question? Compute the operating income, EVA, and it's given that Tender Limited has 6 lakh equity share outstanding. How much dividend can the company pay before value of entity starts declining? Okay, what's the question? Tender Limited has earned a net profit of 15 lakhs after tax at 30%. So tax rate is 30%, and this is net profit after tax. Interest cost charged by financial institutions was 10 lakhs. Okay, so interest is 10 lakhs. Invested capital is 95 lakhs, of which 55% is debt, so 45% is equity. Then company's WACC is 13%. We need to find out operating income, EVA, and max dividend that the company can pay before value starts declining. Okay, so how do you find out the operating income? We have PAT. So with that, we'll find out PBT. Then PBT plus interest, we'll get operating income. Then what is EVA formula? No PAT minus WACC into invested capital. So you have WACC, you have invested capital. And what is no PAT? No PAT is nothing but operating income net of tax, right? So you get EVA. So what is the max dividend that you can pay? That is EVA by number of shares. Okay, now let's put this on Excel. Computation of operating income. Okay. Particulars. Okay. So what is given? Earnings after tax. Okay. How much is it? 15 lakhs. So what is earnings before tax? 15 lakhs by 1 minus tax rate. Right? Now you have to add interest. Equals to this plus interest is nothing but 10 lakhs. Okay, so operating is equals to interest plus EBT. Yes. Okay, you have got operating income. Now we'll find out no PAT into 1 minus tax rate. Okay, now WACC given, what is it? 13%, right? WACC is 13%. WACC into invested capital is what we want. CC into total capital. WACC into total capital. What is that? Is equals to 0.13 into 0.13 into 95 lakhs into 95 lakhs, right? So what is EVA? EVA is nothing but no PAT minus WACC into this one. Okay, right. So what is max dividend? What are the number of shares? Shares is equals to 6 lakh equity shares. 6 lakhs. So what is max dividend that it can pay per share? Max dividend per share is equals to EVA by number of shares, right? So this is the solution. Now let's do problem number 12. What is being asked in the question? Compute the weighted average cost of capital for each company. Compute EVA. Based on EVA, find out which is the best investment. Then if industry PE is 11, then estimate market price. Then calculate market capitalization for all the three companies. Okay. So what is the tax rate? Tax rate is 35%. Okay. So what are the details given? There are three companies that are identical except for their capital structure. Okay. So what are the details given? Total invested capital, debt by assets ratio, shares outstanding, pre-tax cost of debt, cost of equity, operating income, that is EBIT. So how do we find out WACC? We have pre-tax cost of debt. So into 1 minus tax rate gives us post-tax cost of debt. We have cost of equity, and you have weights, right? Weight of debt is 0.8. So weight of equity will be 1 minus 0.8 because debt by assets ratio is given, not debt by equity. Okay. So yeah, this is for orange I was talking about. Yeah, so based on these things, we'll find out WACC. Then how do you find out EVA? You have EBIT, so into 1 minus tax rate gives us NOPAT, and you have WACC, you have invested capital. So the formula is NOPAT minus WACC into invested capital, right? So based on this, we'll find out which is the best investment, which has greater EVA, that is the best investment. Since P is 11, we need to find out market price per share, right? So what do? We find out from EBIT, we have to find out EAT. How do we do that? EBIT minus interest expense gives us EBT, then minus tax gives us EAT, divided by number of shares gives us EPS. EPS into PE gives us market price. How do you find out the interest expense? Interest expense. You have pre-tax cost of debt, that into debt amount. How do you find out the debt amount? Debt amount is nothing but debt by assets ratio into total invested capital, right? So so that is how we are going to find out the market price per share. How do you find out market capitalization? Market capitalization is nothing but MPS, market price per share, into number of shares. Okay, so now let's go to Excel to solve the problem. Particulars: orange, grape, apple. Orange, grape, apple. Total invested capital. Total invested capital. What is it? 1 lakh for all three cases. Next, debt by assets ratio. Debt by assets ratio, that is 0.8, 0.5, 0.2. 0.2. Okay, so what is debt amount? That is, it is nothing but debt by assets ratio into total invested capital. So what is equity? Oh, sorry. Total invested capital minus debt. Right. Next, what information is given? Shares outstanding. Shares outstanding. How much? 6,100, 8,300, 10,000. 6,100, 8,300, 10,000. Yes, 10,000. Pre-tax cost of debt. Pre-tax cost of debt. 16%, 13%, 15%. 16%, 13%, 15%. This should be in percentages. Post-tax cost of debt. This is equals to 16% into 1 minus 0. What is the tax rate? 35%. 0.35. Right. So okay, this come to 10%, 8%, 10%. What is cost of equity? 26, 22, 20. 26%, 22%, 20%. Right? Now we have to find out WACC. That is equals to cost of equity into its weight plus post-tax cost of debt into its weight by total weight. So this is the weighted average cost of capital. What else do we need to find? Economic value added. Okay. You have EBIT 25,000, 25,000, 25,000. Find out NOPAT. That's what EBIT into 1 minus tax rate. So this into 1 minus 0.35. Right? So WACC into invested capital, that is equals to this into so what is EVA? EVA is nothing but NOPAT minus WACC into invested capital. So this is EVA, right? This is WACC. Okay. This is the best investment. So orange is the best investment as its EVA is the greatest. Okay. Next, what else do we need to find? We need to find the market price per share. You have EBIT. What is the interest expense? Pre-tax cost of debt into debt amount, right? I'll just put minus because it's an expense. So you get EBT. This is equals to sum of these two. So EAT, it is nothing but EBT into 1 minus tax rate, right? Okay. Next you'll find out number of shares. That's already given. That is equals to, it's already given, right? So I'm just linking it here. So now we'll find out EPS. EPS is nothing but EAT by shares outstanding. P is already given. Okay, that is 11. So MPS, that is P into EPS. Okay, so this is market price per share. Now market cap, market value, market cap, market capitalization, market cap is equals to MPS into shares outstanding, right? Yeah. So is there anything else to be calculated? There are 5 questions. 1, 2, 4, 5. Yeah. So there is the solution. Now let's solve problem number 13. What is asking the question? Calculate EBIT, EVA, and if it has so and so shares, find out how much it can pay in dividend per share before value of company would start to decrease. If it does not pay any dividend, then what would you expect to happen to the value of the company? Okay, let's go to the details. You have a net income as 15 lakhs, marginal tax rate is 40%, interest expense is 15 lakhs, and company has 1 crore of invested capital, of which 60% is debt, and it tries to maintain WACC of 12.6%. This is same like previous problem, right? I think it is 10 or 11. So let us not do this problem. Okay, it's just a repetition. But one thing is that it is given, if it does not pay any dividend, what would you expect to happen to the value of company? Naturally, it will rise, right? Okay, so let's move to problem number 14. Problem number 14. What is asked in the question? You are required to compute economic value added and market value added. Market value added is nothing but market value minus book value. Okay, assuming that WACC is 12% and the share of company currently quotes at $50 each. Okay, so what are the details given? The following data pertains to XYZ Inc. Okay, it is engaged in software consultancy business, and you have income from consultancy. You have EBIT less interest on loan. You get EBT and tax rate at 35%. So you get EAT. Then you have balance sheet. Okay, equity, reserves and surplus, loans, current liabilities, land and building, computers and software. You have current assets, debtors, bank, cash, and all. So you need to find out economic value added. Okay. So what is the formula of EVA? EVA is nothing but NOPAT minus WACC into weighted average cost of capital. You have WACC here, yes. Then what is NOPAT? NOPAT is nothing but EBIT into 1 minus tax rate. What is the total invested capital here? Total capital minus current liabilities is the total invested capital. Equity, reserves and surplus plus long-term, borrowings. Okay, that is your total capital. So with this you find EVA. Then what is market value added? Market value added is nothing but market value minus book value. What is market value? $50 into number of shares. What is book value? 100 million plus 325 million is your book value. That is equity plus reserves and surplus, right? So now let's put this on Excel. Let's put this on Excel now. First, we'll find out economic value added. Particulars amount. That is in dollars, in million, right? In million. Okay. So we have EBIT. EBIT. What is EBIT? 180. What is NOPAT? This is equals to this EBIT into 1 minus tax rate. What is tax rate? 35%. 0.35. 35%. Okay. So what is WACC? It is given, right? Wait, WACC is 12%. We'll just find out. Yeah, WACC is 12%. Invested capital will rate. Invested capital. That is equity, reserves and surplus, and loans. Equity. How much is equity? Equity, reserves and surplus, surplus loans. 100, 325, 180. 100, 325, 180. Right. So yeah. So invested capital is equals to okay. So let us just treat this as working note. Okay. Invested capital. Okay. So now WACC into invested capital, that is invested capital into 0.12, right? So what is EVA? EVA is nothing but NOPAT minus WACC into invested capital. Okay, right? That is your EVA. Then what is MVA? MVA, for that, what is market value? That is equals to 50 into how many shares? 50 into 10 million, no? 10, 500. What is book value? Book value is equals to equity plus reserves and surplus. So what is market value added? Market value minus book value. Right? So there is the solution. Now let's do problem number 15. Okay, what is being asked in the question? You need to find out EVA. Okay, let's go to the details. There's a company which has earnings of 12 lakhs after tax. Okay, it has a patent. It has a patent of 40 lakhs. Okay, and its assets include 20 lakhs of working capital, 80 lakhs of property, plant, and equipment. Okay, and it is shown that the payment is the patent is not shown on its books. Okay, and its cost of capital is 15%. You need to find out EVA. So how do you find out EVA? EVA is nothing but NOPAT minus WACC into invested capital. What is the total capital? Total capital is nothing but patent rights, because it is not written in, it is not entered in the books, plus working capital plus property. That is the invested capital into 15% you'll do. Okay, that is WACC into invested capital. What is NOPAT? NOPAT is nothing but 12 lakhs after tax. Okay, so we'll find out EVA now. Particulars amount. Okay, let us find out invested capital first. Patent, property, plant and equipment, and working capital. Patent, property, working capital, right? How much is the patent? Okay, everything in lakhs. 40, 80, 20. Okay, 40, 80, 20. So invested capital equals to sum of all these. Okay, WACC into invested capital, that is equals to this into what is WACC? 0.15, that is 15%. 15%. Okay. See it 15%. Next, no pat. How much is it? 12 lakhs, right? 12 lakhs. So what is EVA? No pat minus WACC into invested capital. So this is EVA. Done. So problem number 15 is done. Now let's go to problem number 16. What is being asked in the question? See, you need to find out economic value added, that is EVA. Okay, let's go to details. Okay, there's a company. There's a company that has a patent having market value of 100 crore, and it is not recorded in books. Okay, net worth is 200, long-term debt is 400. Okay, product generates a revenue of 84 crore, and government bond rate is 10% per annum. Okay, and market portfolio generates a return of 12% per annum. The stock of company moves in tandem with the market. So even companies, even the company generates 12% return. That's how we understand. Okay, so we need to find out economic value added. How do you find out economic value added? What is the formula? No PAT minus WACC into invested capital. How do you find out weighted average cost of capital? See, you will take cost of equity as 12% because the stock of company moves in tandem with market, and market portfolio generates a return of 12%. Okay, now what is cost of debt? Since you have no other information, you'll take the government bonds interest rate only, that is 10%. Okay, so what are the weights? Weight of equity is 200, debt is, equity is 200 plus patent, that is 100. So it is equity is 300, debt is 400. So the weights is 3 and 4. Okay, so with that you will find WACC. What is the total invested capital? Invested capital is nothing but patent plus net worth plus debt, that is 400, 200, 100. Okay, so it is 700. Okay, so what is no PAT? No PAT is nothing but it is revenue, that is 84 crore, right? Yeah, correct. Yeah, so now we'll just put this on Excel now. Plus amount in crores first find out invested capital, patent, net worth, debt. Net worth, debt. Patent is 100. How much is net worth? 200. Debt is 400. So invested capital in total is 700. Okay, so what is weighted average cost of capital? Yeah, WACC. Okay, yeah, equity is equals to sum of patent plus net worth, because patent is not included in books, right? That's why. Debt, that is 400. So these are the respective weights. Okay, cost of equity and cost of debt. What is cost of equity? That is market return, that is 12%. What is cost of debt? That is government bond rate. Government bond rate 10%, 12%, 10%, right? So what is WACC? WACC is equals to cost of debt. Okay, let me put cost of, yeah, cost of equity into its weight plus cost of debt into its weight by total weight. This one we want in percentage. Okay. So here what do we do? WACC into invested capital, that is this into this. Okay. So what is NOPAT? Is it given? Yeah, 84 crore. 84 crore. So what is EVA? Is equals to NOPAT minus WACC into invested capital, that is 8. So with this, we have done all questions of corporate valuation. Thank you so much.